Good morning, everybody. Happy Thursday. It's October 12th, 2023. Great to be with all of you today. My name is Bob Lang, and I run explosiveoptions.net, along with an amazing, wonderful chat room from some amazing people as well, too. It's time for our daily bites. So let's talk about markets and what we've had for the last couple of days. Certainly has been quite bullish. If you're long this market, it's been real good for you. I'm optimistic about things to come, but we're approaching some levels where we have to be careful. And it's never a bad thing to take some money off the table if you have some gains, certainly over the past couple of days. So let's talk about it real quick. So we see futures are up about 10, 11 handles over here, a little bit off their lows after the stronger than expected CPI number came out. That came out about 20 minutes ago. Took a look through those numbers. I'll give a little bit of analysis there in just a moment. We see the Dow is up about 100 points. The Nasdaq up about 18 to 20 or so. On the board over here, we see Target up. They got an upgrade today. It's a stock that we added yesterday. Tuesday. First Solar is another one we added a couple of days ago as well too. That's up about $5.50 here. So we're getting some nice movement on those names. Delta, which is a stock that I added in the chat room, and you can see this. Where was it? So it was right. It was right here. I'll add a few Delta January 35 calls at $3.40. That stock is now up about $1.20 here, following earnings, up a nice 3.5%. So we'll see how that one goes. We did have some others. We added some puts. We sold some Amgen at a really nice gain yesterday. Added some Walmart. Sold some Google calls, which we're in from the prior day. Some Meta added some of that in November 20th, 325 medical. So you can see what we're doing, and added some Citigroup. They have earnings coming out tomorrow morning. So that's what we've been doing in the chat room, along just for my work, for my stuff, but everybody else has been pretty active as well too. So why do we need to be a little bit more aware right now of the market conditions? Because we're a bit overbought, right? And even though we had a nice shot through 44.30 earlier this morning, we're only at about 12, 13 handles off that level. Take a look at the oscillators here, right? If I can bring it up. Okay. 106 on the Nasdaq, 114 on the New York Stock Exchange oscillator. So these are pretty overbought here. We were positive on the breadth yesterday, 17 to 10, or 17 to 11 on the positive side. We saw the, we can take a look at the internals from yesterday, and you can see that yesterday we had a nice positive move up towards the end of the day on the VOLD. Not quite the violent move up that we had the prior couple of days, Monday and on Friday. ADD started moving back up, but we saw the big, huge drop here in volatility here, and that often happens, everyone, when the news gets released. And it's been happening since November of 2022. So once we got that CPI number out on that day, I want to say it was November 10th or 9th, markets really started to react. After that, what ends up happening is volatility starts to drop, and the offsetting move is a rise up in futures. Futures volatility goes down, futures respond and go up. So that's just been the rule here for the past year or so. We see the trend was down, put call ratio up a little bit yesterday. So these internals weren't bad. They were not great at the beginning of the day when the market started up. They came down about 9-10 handles on the S&P 500 and bounced back sharply and closed near their highs of the session. So that was a pretty good move by the markets yesterday. But as we see here, the futures are pulling back a little this morning off their highs of the early morning before the CPI number was released. Now let's take a look at that CPI number here. The core number came in basically in line with expectations. The middle line is middle column here is expectations, 0.3. on the month over month, 4.1% on the year over year. So that's basically in line. The headline number, though, a bit hotter than expected, 3.7 versus 3.6, which is basically flat from the prior month. 0.4, which is down from the prior month, which was up 0.6. Remember, 7.2% annualized. So where are we at right now? We're at a 4.8% annualized inflation rate. Still too hot for the Fed, but it is coming down from the prior month. So we have, we take a look at the Cleveland Fed net inflation nowcasting, and you see that in September they were pretty much spot on with what they were expecting. At 0.39, we came in at 0.4, and the core number again. Let's look at that. They're expecting 0.36. That came in at 0.3. Yeah, I don't exactly know what if it's 0.36, but it's pretty close. They were probably a little bit hotter than most people were expecting. But look at October. October is coming down to 0.21 month over month, right? So that equates to about 2.5 to 2.6 annualized. So the CPI, as predicted by the Cleveland Fed, seems to be moving in the right direction, right? So we'll see if that comes out what they're expecting, and that number will be out in about a month, in the second week in November. But inflation year over year is starting to come down, at least at the very worst, going flat, going straight line, and maybe coming down. So, there is still a good argument for another rate hike. Let's see what the Fed funds futures are looking like. They are coming in at well, let's see here, 8% chance of a rate hike in November. Go out to December, last meeting of the year, and it's about a 39% chance. So you add 36 to 2.7. That's about just under 39% chance of a rate hike in December. 2.7% chance of a double rate hike. So it's still people are still bidding on that. They're putting a bid on a double rate hike in December. And if you go out to June, you're looking at the likelihood of getting back to 5%. So if we go from 5.25 to 5.5, the June number is looking at 2 rate cuts by that meeting. So obviously, lots and lots of data between now and June, and that could change quite drastically, and it did over the past 6 days since the last jobs report came out. In fact, if you were looking at the futures market all the way out to December last week, before the jobs report came out, there was only a prediction of 1 rate cut by the end of December. Now I think they're pretty much predicting 3 rate cuts from where we're at right now. So if you look at it, 4.5%, 3 rate cuts from the current. Again, this is a number that people can look at, and if they're trying to trade on this number, it's futile. It's absolutely, it's useless to try and trade off of these numbers. But it's a good guideline to understand what the Fed could be doing, could be watching, and what the data is telling Fed funds futures traders. Okay, let's take a look at the S&P 500 here, and we see a nice rally over the past 5-6 days. And I talked about this on Monday, right? What did I talk about? Monday, I said that this level here, this 42, call it 42.10 to 42.30 level, was holding firm for 4 days in a row. You don't often see that, right? But what's happening here? So the market was coming down last week for these few days. There were buyers coming in there picking it up, right? Now, could we have predicted that? Probably not. No, it's very difficult to predict that. But after the fact, certainly we can make an assumption that buyers are picking it up here, and that this support level is going to be pretty strong. And we're right, and the 200-day moving average is coming right up into that zone right now, 42.16 for the 200-day moving average. So we're right up there, right? So, if we do come back down and test that area, it's going to be testing the 200 moving average this time. Last week, it did not test the 200-day moving average. You can see how close it was. However, I did mention as well, too, last week that the ES futures did break through the 200-day moving average for that contract last week at one point. So it did bust through that 200-day moving average and rallied significantly off of that last week. So something to think about. Right now, we're trading in a wide range between the 200 and the 100-day moving average, and we can see that 50-day moving average is coming in hard and is going to cross that 100-day moving average probably within about 3 days. Right? That's I call that a mini death cross if you want to. It's pretty well separated. It's got a lot of separation, over 200 points between the 50 and the 200-day moving average. Again, a lot of width between these two moving averages. The 20-day moving average, which is key short-term moving average, that's about a month's worth of activity, is one that we watch very carefully and pay attention to. We closed above it on Tuesday and confirmed that move up there on Wednesday, so yesterday. So we need to watch that and see if we can get a higher high and a higher low today. And what would really be good for the bulls if we could get above Tuesday's high. Now, what is Tuesday's high? Tuesday's high on the S&P 500 was 43.85. So if you get above 43.85, you got something into Friday. Now, of course, Friday is a big earnings day for the bank. So you got JP Morgan, you've got Citigroup, BlackRock, Wells Fargo, PNC as well, and a couple other. United Health also reports tomorrow, along with Progressive. So it's the start of earnings season here right now. Let's take a look at the Fibonacci's here because I think we can probably trace out the bottom level of this and do this on two different levels, three different areas here. So let's look at this one here. Okay. We just crossed that 36% retracement level. So let's pull it from here as well. And then we'll also pull it from this top. So I'm putting numbers on top of each other, but I just want to see where they cluster at, right? So we're kind of clustered in here between here and here. So you're going to get pretty stiff resistance there. Let's call it about 44.10. Makes sense because there's a gap to be filled just below that 44.10 is about 44.02 or so. So we get a gap fill up there. I suppose we're going to get some rejection. If we do get up there, say the next couple of days, I think that we'll be overbought. So it really makes sense to start taking money off the table now, or as we move up towards that level. Again, if we get above 43.85, I think we make a shot right up there to that 4,400 to 44.10 level, where I think we'll meet significant resistance and start coming back down. So we could make a run like this. Hold on, that's not. I didn't want that. See here. Okay. Could make a move up to there, come back down there, make a higher low, and then a lower high, and then come back right back down there to that 43.39, and then over the next couple weeks, and then make a move back up, right? That could be, we could trace that, and that would be making a higher low on the chart, and that would be bullish. Okay, so that's just one scenario. There could be lots of different scenarios there we could trace out there, but that's one that's certainly a possibility there. All right, based on Fibonacci's, I think that you got to take a look at that. That is an iron resistance level, 4,400 to 44.10. Okay. Let's see here. New highs, new lows. This is the chart I've been using a lot lately, and watching and sharing it with all of you. We did have the new highs on the Nasdaq poke its head above zero yesterday, but came back down and closed lower. That's important, but we need to have a couple of closes above that zero line, and then up there to be a little bit more positive. We did have a couple over there, and then we failed in early September, and the Nasdaq has been underperforming since then. At least on a breadth standpoint, breadth in the IWM has been a little bit better. It's not been good, but it's been better than this. The other indices have been doing better with their breadth. far as stocks are concerned, this is one that they got an upgrade today. This is one that we bought the other day. Again, I told you about First Solar. Not one of my favorite chart patterns over here, straight down, but it did get way extended past this 20-day moving average. So we put in a buy order in Tuesday before it made this shot right up there, and it made a move above to 155. So it gets above 155 here today, folks. This has got some room to go, at least to the 20-day moving average, 160 before it stalls. We're not overbought here, nearly overbought, even in the short term. We have a lot of moving averages to test up here. It could take some time, could take several weeks, maybe a couple of months to make a move back up here. But I think back up to this 190 to 200 area is pretty fair game for First Solar. Again, not going to happen in 3 days. Probably going to happen if it does over the next couple of months. Maybe you want to buy some longer term call options on that one. I have some JP Morgan as well too. Not a great looking chart, probably the best looking chart among all the banks. Bank of America, Wells Fargo, Citigroup, they all look horrible. But JP Morgan, not looking great either, but look, it's tracing out a nice W pattern here. And you can see that the lows at around 141 seem to have held for a second time from last week. So we get above, got to get above 149, 150 here before we can call it an all clear on JP Morgan to move up much higher. So lots of work to do there. So I think it's going to be it, everyone. Have a great day. Have a great weekend. I'll see you guys all back on Monday, and we'll see if the banks start the markets moving to the upwards direction. Again, remember something. Pay attention to that 4,400 or 4,410 area. If we get above there or get near there, caution is warranted. Red flags, and you got to pay attention and start taking some money off the table. Why not do it today? Keep some protection on as well too. Raise some cash, sell some positions, have some puts on, and away we go. Thanks everyone. Have a great day, and I'll see you all on Monday. Have a great weekend. And if you're in the chat room, I'll see you there. Bye.